Thank you everyone for taking the time to watch and listen today. Today is Friday, October 7th, 2016, and this is the third quarterly scouting report. My name is Adam Koch. I am President and Portfolio Manager at Libertas Wealth Management Group in Columbus, Ohio, and let's just go ahead and get right into this. First of all, before we get started, I just want to point out you have the ability to increase your screen resolution by clicking on the little wheel at the bottom right hand corner of your screen here. You'll have some options. Basically what you want to do is you want to pick the highest quality option, ideally HD, which just makes it a whole lot easier to see and read these charts. So alright, let's just jump right into the material. First of all, let's talk about today's agenda. First thing we're going to discuss is gold and the US dollar. So I'm going to go backwards a little bit today. Normally I talk about the stock market first and then kind of get into some miscellaneous things, but today we're going to start with commodities, gold, the dollar, commodities in general. Then we're going to move on to interest rates and bonds. And finally, I'm going to kind of talk about the S&P 500 stock market and so on, a little bit of analysis, both long and short term. Then I know everybody wants to talk about it. I really don't, but I'm going to do it anyway because I know people want to know what's going to happen or what might happen depending on who wins the presidential election and what that might do to the stock market and investments in your retirement portfolio. And then last but not least, we'll go over kind of a game plan for quarter four through the rest of this year. So if we jump right into our first chart here today, we've got gold. So gold's taken a pretty big beating, and that's why I wanted to start with it today. This past week, call it week and a half, you can see here how gold's really gapped down. This is the little gap here, and what I mean by gap down is it closed at a price yesterday, let's just say, and then opened at a price well below yesterday's close. That's what's called a gap down. The same can be said for the inverse with a gap up. But anyway, so where we are right now is we've had a few really, really bad days in gold, and a lot of that's been due to the US dollar. And so here's a chart for the US dollar, and you can see here the dollar's been going down really since late 2015, and then recently formed a triangle pattern here, a symmetrical triangle, and it's been bouncing up, down, and back up again, and it's sitting and resting off this trend channel here. The question right now is whether or not the dollar is going to go up or if it's going to come back down. If it went up, it would run into resistance right here at about 25.2 on the UUP. The next resistance would obviously be right up here at the March highs. But my point in bringing up the US dollar is that the dollar and gold are inversely related. Now you can buy gold in any currency you want if you have a foreign exchange account. But when we're buying gold, we're typically buying it in US dollars, of course, so when the dollar goes up, gold goes down, and vice versa. When the dollar goes down, gold goes up. What I want to point out on this gold chart really quick here is aside from the fact that we have very, very, very solid support here that goes back to February, March, April, and May, so that's going to offer a nice little line of defense for gold to bottom and potentially bounce off of if it doesn't bounce off this support here from the bottom in June, which was the Brexit bottom. But the second thing I want to point out is how oversold gold is right now. It's more oversold than it was at the bottom of the precious metals bear market, which went back to 2015 in late 2015 in November. So what this basically means is it really, I don't want to say it can't get much more oversold than this, but it'd be pretty tough to do so. So it looks to me like gold is probably closing in on a bottom here before it reverses its trend back upward. Of course, long term, we'll have to see what happens and whether or not it prints new highs up here above these levels. But again, going back to the US dollar, we could get a lot of help if we see the dollar break down and go below this bottom level of support here. And again, kind of like gold was oversold, you can see here the US dollar is also extremely overbought or long in the tooth. So switching over to a kind of bigger picture, commodities. Commodities obviously include gold, precious metals, so gold, silver, palladium. It also includes energy such as oil, natural gas, gasoline. It also includes agricultural commodities like wheat, soybeans, corn. And when you look at the broad commodities basket, you can see here the commodities kind of tanked over the course of a few years and bottomed out here at the beginning of the year, reversed upward and kind of started to form a positive trend. And then it's been trading in that similar triangle pattern, that symmetrical triangle pattern we were looking at with the US dollar. Just this past week, actually, we saw a breakout in commodities, or in other words, the DBC, which is the Power Shares Commodity Tracking Index. And so far anyway, that's holding above that breakout. So sometimes we can see head fakes where it'll peak above this line and then continue down, or vice versa. We can see head fake breakdowns where it'll break down below this level and head back up. But at least so far, we're seeing, first of all, a breakout above this symmetrical triangle pattern. And second of all, from a momentum standpoint, price momentum oscillator, which is a momentum indicator, is now pointing up and issued a buy signal recently, and seems to be accelerating northward. So this looks pretty safe anyway right now in the short term, even to intermediate term. When we look at the long-term picture for commodities, what we'll find is obviously we've seen the big, huge downtrend in commodities that went back to about mid-2011, and then now we've seen this thing bottom out in 2016, like I showed you on the previous picture. So here's the bottom early 2016. In the short-term picture, here's the bottom on the long-term picture in commodities, and this is the CRB index, so commodities index. What I want to point out on this picture, this is Martin Pring's KST, which is another momentum indicator, and you can see here's a buy signal. You can see there was one back here as well back in 2009 before the commodities market went up pretty dramatically in a very big way. And these arrows indicate the other times when the KST issued a buy signal as well. And it's been pretty reliable, especially when we're at oversold levels, which is where we're at right now. So long-term, commodities also look pretty good. Changing the page over here to bonds, talk about bonds for a second. This is a big chart that goes back a really long time. Some of you listening or watching this video aren't going to remember, and some of you might not even have been alive back when this happened. But back here in the late 70s, this was back when you could get CDs at the bank paying 16%. Bonds had bottomed out in the early 80s, and then that was because interest rates topped out. Interest rates go down, bond prices go up. If interest rates go up, bond prices go down. So what we've seen for the last 30 years is this rising trend channel in bonds, because interest rates have been going down since the 80s when, like I said, mortgage rates were super high, inflation was super high. Like I said, you could get CDs at the bank paying 14, 16%. Those were the good old days, right? But these days, we're sitting towards the top of, I can't say this is going to be the top of the bull market in bonds, and in other words, the bottom of the bear market interest rates, but what I see on this chart is a little peak here, a little breakout of this trend channel, and then it's starting to head back down, which is why we've been short bonds in a couple of our portfolios. But you can see bonds recently broke out and then head faked above the trend channel. If this 30-year trend continues, then we should see bond prices fall in the intermediate term, and interest rates should rise in the intermediate term. This is a shorter term picture of that same trend channel, except this just goes back, you can see, to 2007. Here's a peak in that trend channel, and you can see a couple points of support here. Here's another point of resistance, which then becomes support. It breaks down, but you can see as soon as it bounces off this trend channel, we see a rise in bonds. Then all of a sudden it bounces down off the trend channel and gets below this level of previous resistance, so new support, heads back down, bounces off the trend channel, prices go back up, goes down, doesn't quite get down to the trend channel yet, but again, peaks up here and then heads back down, at least in the near term. So the question they have now is, are bonds going to continue going down in the near term, call it intermediate term, the next, call it 3-6 months or so, and are interest rates going to continue going up? And we're just going to have to continue observing that and placing our trades accordingly to make sure we benefit from either move in either direction. Moving on to the stock market. So first of all, I just want to show you here, this is a chart that goes all the way back to October of 2014. This is October 31st back here of 2014. This was the end of the last stimulus package, which was implemented by Ben Bernanke, the old chairman of the Fed. So this is QE3 ending, and you can see here, market kind of staggered around, struggled, fell. This is the big drop, 12% plus drop in August of last year. Then it came back, didn't quite hit new highs. Here's the next big drop, 14+% drop in the market between November and February. Here's the rebound off the bottoms that we've seen. Here's Brexit right here. This is the big, huge, call it 2 to 3 day drop in the market due to Brexit. And then since then, we can see this just kind of consolidation or this creepy crawliness in the market going sideways. But the point of this thing I want to show you here is that in almost 2 years now, The S&P 500, the market's only up 6.7% since the last stimulus package. And if you look at one of our older videos, I think just from last quarter, you can see I've got a chart in there that shows you how the market's done during stimulus and how it's done after stimulus ends. And this theme kind of continues to trend forward here. I mean, when stimulus ends, the market struggles. When stimulus jumps into the market, whether it's dropping interest rates, whether it's buying and selling long and short-term bonds, whether it's printing money, it doesn't make a difference. Generally speaking, when stimulus is implemented, we start to see the market go up in the short term until it ends, at which point the market struggles. If we look at a different time frame here, this is the May all-time high, so previous all-time high, I should say. So obviously we've broken north of that May 2015 high here in the most recent history. But here's the May all-time high, and what I want to point out here, similar to the slide we just looked at, looking at stimulus and how the market's only up 6.7% since the end of the last stimulus package back in October. Since May of 2015, so we're working on 18 months here, the market's only up 1.22% since breaking out of all-time highs. And again, it's continuing to struggle here. And that's again after the market broke down, went over 12%. It went down more than 14% here in November through February. And now we're just kind of putzing along trying to figure out where we want to go. Short term, if you look at the market since midsummer, you can see that you could have gone to sleep in mid-February and hibernated all the way through summer and woken up this week, and you would find that the market's gone absolutely nowhere. So a pretty difficult market to try and determine any kind of trend, whether up or down, and that is kind of the thesis of transitioning to what I think we need to do going forward. So this is again an S&P chart. This goes back 2 years, but what I want to focus here on is this is again momentum down here at the bottom. We can see a high of momentum here in April. Then we can see it go down as the market fell and as Brexit came in. Then we can see an increase in momentum, but we see a lower high, but the market went up. So see this higher highs in the price, lower lows in momentum, and most recently you can see how this momentum indicator, which is usually pretty directional. I mean, it decides which direction it wants to go in most cases. But you can see on this 2-year chart, you'd have to go back a few years before you'd find something that looked like this very, very flat to negative bias. So again, this is kind of bringing some concern. I don't think it means the market's going to crash tomorrow or anything like that, but I do think that it means that we are neutral. So you don't have to be bullish or bearish. You don't have to think the market's going up or down. There's nothing wrong with being neutral and kind of sitting in a wait and see mode, which is where we are now. And probably one of the biggest reasons we're in a wait and see mode is because of this. This is a similar chart to what you were just looking at before, but this is a rising wedge pattern. So if you look at the market since February, since that rebound off the lows, February 11th lows, you can see this rising wedge, which is typically a bearish pattern. In other words, typically what you see with these patterns is the market usually breaks out down, not up. Now, is it possible? Due to any number of circumstances we'll talk about here in a couple seconds, due to the Fed and so on, that this market could continue up before it breaks down? Yes, absolutely. Is it also entirely possible and even probable that we could see a drop in prices here before markets continue up? Yes, that's also possible. But right now we don't know. And as I always say, I don't think that we want to try and predict what the market's going to do. I think we want to let the market tell us what it's going to do. In other words, let price confirm our opinion and then act. Don't try to guess what price is going to do and then hope it works out in your favor. So we're kind of be watching this thing to see what happens here over the next week or two, even longer, depending on what happens with the market here in the election. So good segue. Let's talk about the U.S. presidential election because everybody wants to talk about that. All right. So first of all, I don't want to say it doesn't matter, but the market doesn't really care who the president is, and we could go back and forth on whether or not it makes more sense to have Republicans in the presidency or Democrats. We can talk about how returns in the stock market are typically better when Democrats are in the presidential Oval Office. None of that matters to me. What matters right now is that betting odds, which are the only reliable, in my opinion, the only reliable indicator that suggests who's going to win the presidency, betting odds suggest the chances are between 71 and 77% that Hillary wins the election. Okay, I mean that's those are huge odds, and I would much rather rely on those odds than I would on a CNN poll or a CNBC poll or a Fox News poll or any of those polls, because obviously the news is in business to get you to watch the news, and the more exciting they make this election and the closer they make it, the more neck and neck Trump and Clinton are in, the more you're going to watch the debates, the more you're going to watch the news, and the more you're going to pay attention to the commercials that they're both paying so much for. So the reality here is, chances are that Hillary Clinton's probably going to win the election. I mean, it'd be a shock if she didn't. And I suppose now's a good time to say that if Trump did win, I think it would probably shock the market, not only here but overseas, because everybody kind of knows what Hillary's going to do. Everybody knows that the policies would roughly stay the same as we've seen for the past 8 years. There might be some changes, but generally speaking, things would kind of stay the same. And the market wants to see stability. The market hates, as I put down here, the market hates uncertainty. So we kind of know what Hillary would do, but we really don't know what Trump would do. Granted, whatever the president does has to be agreed upon by Congress and the Senate, so it's not like there's any one person in this country who can just make things happen tomorrow with the sign of a pen. There's things they can do to overturn executive orders even. So I wouldn't freak out about this kind of stuff, regardless of what side of the table you're on, or if you're in the middle, kind of like I am. But anyway, the investments likely to favor a Hillary win would be things like solar stocks, clean energy, and natural gas. Ones you'd probably want to avoid, assuming a Clinton win, would be energy, like coal specifically, but coal, oil, and things of that nature. Private prisons, biotech, and pharmaceuticals, the latter of the two, primarily due to regulations, regulation changes. If Trump were to win, it'd be the opposite, really. I mean, I think Trump would be probably good for energy. I think that he would probably be good for private prisons, biotech, pharma, some opposite regulation changes. But again, I just want to reiterate, I mean, these betting odds are based on a website called oddschecker.com. You can look it up yourself, where an odds checker checks over 25 different betting markets overseas. And this is the average, between 71 and 77% when you compare these 25 plus betting odds. So, I mean, I think we kind of know what's going to happen here. The rest is a reality show, in my opinion. So let's talk about our game plan going forward. So, big picture. When you consider the ridiculous amount of debt in our country that we've amassed here, and the huge numbers of people on unemployment, disability, welfare, the huge numbers of those people who are still working, but instead of one full-time job, they're working, say, 2 or even 3 part-time jobs instead. When you look at the numbers released by the government, they count on those 3 part-time jobs, or in other words, they count those 3 part-time jobs as 3 jobs. So those 3 part-time jobs count just as much as 1 full-time job, which makes the economy and jobs picture, when it's reported, look a whole lot better than it really is. So if somebody ends up losing their job or has to go down to part-time because a company's downsized, but then has to replace that 1 full-time job with 2 jobs, the economic numbers we look at every Friday on the ADP jobs report, they count 2 part-time jobs as 2 jobs. So I don't think that's a realistic picture. So basically, when you look at the economy, it would seem as if this market has to collapse at some point, or should have collapsed a couple years ago, and you'd be correct in your gut feeling if you felt that way. But interest rates have been 0 now for years, an act by the Federal Reserve to allow Wall Street and central banks to recapitalize their messed up balance sheets from all the mistakes they made during the mortgage crisis. By keeping rates near 0, they didn't have to pay investors like you and I much for CDs, money market savings accounts, interest-bearing checking accounts, and so on. So they were able to make up for all the bad decisions they made by penalizing the good savers in the world. So the market was never really fixed after the crash last time. And as I've said so many times before, Wall Street and the Fed have put a Band-Aid on broken legs, hoping people won't notice. So everything's been kind of limping along here this last few years, and then whenever the market started to fall in danger of another crash, the Fed would use a metaphorical adrenaline shot or an EpiPen of stimulus to keep the tired, dragging market afloat. Today, their adrenaline is telling us rates are going to go up a bunch of times, but then changing their mind. This is only going to work for so long before they have to try something new. But if you look in December of last year, December 2015, the Fed decided to increase interest rates from 0 to 0.25%. We're not talking about leaps and bounds here, people. We're talking about a 0.25% increase, and the market managed to go down from November through February 11th over 14%, went down more than 14%. So I think it freaked them out, and they realized in December when they said, oh, we're going to raise rates 4 times in 2016, and then just 1 month later they come back on TV and say, well, maybe once, we'll have to see. I think that they know that they've kind of gotten in over their heads there, and they really don't have any clue what's going to happen at this point. So what now? What's our game plan going forward? Well, corporate earnings continue lower. The stock market and economy aren't as strong as they look. I think that we just talked about that, and I don't need to go into any more detail at this point. But Janet Yellen and the Fed could continue to do a lot of things. They could continue to say that they're going to raise rates, but then not, which is kind of what they've been doing a lot this last year to 2 years almost at this point. They could turn around and drop interest rates back to 0 again, which in spring, Janet Yellen said she wouldn't do that, but now it's on the table. They could actually drop rates below 0 if they wanted to. And I know that might sound crazy, but more than 50% of countries overseas currently have negative interest rates right now, which means you have to pay the bank for you to hold their money. I'm sorry, you have to pay the bank to hold your money. As opposed to interest rate, there's actually a fee that would come out for the interest rate, the negative interest rate. So we could go there. I mean, it seems unimaginable that the United States would go into negative interest rates, but it is on the table. The next thing they could do is they could start the printing press again. We could see another round of quantitative easing, or QE, or stimulus, in other words. And each time stimulus has been enacted, the resulting boost in the stock market from stimulus has actually been lessened. So every time they've done it, the effect's been lessened. So they'd probably have to do a whole lot more than they've done in the past to get the same result, which is obviously just going to cause more problems down the road as they basically refinance our debt over and over again. And the last thing here, and I know this for some of you that know what I'm talking about, this might sound crazy, but it's entirely possible. In fact, it was just discussed over a week ago. Janet Yellen mentioned that she might talk to Congress about asking them to change laws and allow the Fed and central banks to buy stocks. And I know that might sound crazy, but if we look at the Bank of Japan, by the end of the year, it's projected that the Bank of Japan is going to own 60% of all stock ETFs, exchange-traded funds, so 60% of all stock ETFs within the year. It's projected they'll become the #1 shareholder of stocks in the country. I mean, think about that. The Bank of Japan, it's projected that they will become the #1 shareholder of stocks. What's going to happen when they want to sell? They can't bail out themselves, right? I mean, maybe they'll figure out a way to do it, but it's just like the Fed can't bail out the Fed when they're the ones who created the bubble in the first place. But anyway, the fundamentals, when we look at all the stuff we're talking about, the big picture stuff, fundamental things like interest rates and the economy and so on, the fundamentals aren't matching the technicals. Obviously, the stock market has been resilient, but I don't think that's been due to real supply and demand here. I think it's been due to a lot of people who would normally invest in safe instruments such as CDs, interest rate bearing savings accounts, checking accounts, safe stuff, and they don't have any place to make money. So those people that previously invested in really safe things like bonds have been putting their money in stocks instead, and eventually that money's going to have to come out at some point. We're living in the second longest bull market, or second longest up market in history, and every bull market ends in a bear market. That's just how it is. So in closing, just to wrap things up, there's a lot that the Fed can continue to do to prop this market up should they choose. Of course, we don't know if they will choose or not, but this is one of the hardest things we're going to have to keep our eyes on. In closing, with additional intervention on the part of the Federal Reserve and central banks around the world, it's entirely possible, and this is important, it's entirely possible we could see the market scrape its way higher over the next year, 2 years, even beyond. I know that, again, that might sound crazy, but even if it doesn't make any sense at all from a fundamental perspective, when you look at all the things from a big picture economy perspective, as long as the Fed continues using different tools to basically manipulate the economy and manipulate the stock market, it's entirely possible that we could see the market continue higher. And that's why we have to pay attention to these charts that we've seen in this video here. So that's where I'll end today. Feel free to check us out online at libertaswealth.com. You can follow the company on Twitter at libertaswm. You can follow me on Twitter. I'm not hugely active, but I try to post things every once in a while, and naturally I'll post a bunch of things at once and then do nothing for a couple days. But the handle is at Adam Koch. You can like us on Facebook as well if you'd like. LinkedIn, you can look us up on LinkedIn. But if you have any questions at all, if you want to have your retirement picture looked at, you don't have to be a client to ask a question. We take people through a 3-appointment process to evaluate their portfolio, do a full-blown comprehensive financial plan that will show you when you can quit working, or I should say if you can quit working when you want to, and more importantly, what the minimum interest rate we need to earn you is, or minimum rate of return we need to earn you to ensure that you never run out of money, both before and in retirement. So focus on what you can control, everybody. We can't control the market. The market tells us what to do and we react, right? So focus on what you can control, and what you can control is what you're saving and what you're putting away. Don't let the market spook you. Don't let it freak you out. Don't let it change your saving habits. Again, all you can control is what you're saving and making sure that you're keeping to your financial plan. So if you don't have a plan, or if you haven't had one in a while, or if you want a second opinion and you want to come talk to us, any of our advisors at our office, Andy, Heather, Zach, anybody's here to help you out, answer any questions. Like I said, you don't have to be a client to ask a question. So I'll close out there. Thank you so much for watching, and I will see you next time.